Hello and welcome. You're with us here on Business Today. I'm Abha Bakaya. Here are the day's top stories. Jio Financial Services demerged from parent Reliance Industries. Derived share price set at 261 rupees 85 paise. Reliance rallies more than 1.5%. New subsidiary to pose a tough challenge to existing NBFCs. Markets rally for a straight sixth day. Indices closing at fresh highs. Nifty retreats after falling shy of the 20,000 mark. Traders eye Reliance results tomorrow for the next big push. Huge results shocker from Infosys. More than halves its revenue guidance for the current fiscal. Net profit in April to June falls 3% from the earlier quarter. Streaming giant Netflix restricts password sharing in India. Emails users that accounts are meant to be used within a single household. BTTV answers some of your big questions on the show. The much-awaited demerger of Jio Financial Services from Reliance Industries came into effect this morning. The JFS stock was valued at 261 rupees 85 paise after an hour-long special session was held from 9 a.m. to 10 a.m. to discover its price. The price is much above analyst expectations, who had valued it at a much lower price band. So what happens now and when will the stock list? Let's take a look.
Our digital services initiative.
Mukesh Ambani is getting ready for the first listing of a Reliance company in 28 years. Jio Financial, which was demerged from parent Reliance Industries this morning, will be the only Reliance company to be listed after Reliance Industrial Infrastructure hit the markets in 1995. A special hour-long trading session was held this morning at 9 a.m. to discover the price of the Jio Financial share. Trading in Reliance Industries was blocked till 10 a.m. when the first tick in the stock decided the price of Jio Financial. Reliance Industries began trading at 2,580 rupees Thursday morning, a drop of 261 rupees 85 paise from its closing a day earlier. This difference accounted for the derived price of the Jio Financial share. This price will now stay constant for the next 2 to 3 months, till Jio Financial actually lists on the bourses. Currently, it has been included as the invisible 51st stock in the 50-share Nifty index. This is to ensure the drop in the price of RIL does not affect the index. The stock will be removed from Nifty once it is physically listed in the exchanges. Each of the 36 lakh shareholders of the RIL gets a share of JFS for every RIL share they own. There's, however, no certainty on when the share will be listed. Interestingly, the price of the share is much above what analysts expected. Most estimated its value to be in the 160 to 190 rupees range, giving it an enterprise value of around 1 lakh crore rupees. The actual share price of over 260 rupees puts its value at around 1.66 lakh crore rupees. The demerger puts the new company directly in competition with NBFC giants like Bajaj Finance and Bajaj Finserv, Aditya Birla Capital, L&T Finance, Muthoot Finance and the rest. The demerger is expected to allow Jio Financial to follow a financial tangent of its own and is being seen as a massive value unlocking exercise for the shareholders. Bureau Report, Business Today Television.
So where does Jio Financial Services go from here? Is it still a good buy at this higher than expected derived price? Does it make sense to buy Reliance at these record high levels? My colleague Sakshi Batra got some answers from Ashish Maheshwari of Arihant Capital.
Shares of RIL started trading ex-Jio Financial Services at 25.80 thereabouts. It's right now at 26.15. Your own sense of how should investors be really looking at Reliance Industries right now, and what does this demerger really mean for the existing RIL shareholders?
Yes, this is very important to understand now all these aspects. First of all, this is positive as such for Reliance shareholder because some value unlocking has started. But only my view is that the price which is discovered of Jio Financial Services is quite high because as per company they were expecting that it should be in range of 133 to 135, And this 261 is quite steep, if you ask me. And that also this is giving a market cap of Jio Financial to 1 lakh crore, which is exorbitantly high. Looking at the peer set valuation, which are into retail play, in my view, those investors who have got the shares should try to exit once this get listed, because in my view, these prices may not sustain.
Okay, so right now JFS has been included in the BSE and the NSE indices, but it's still not a tradable stock. Since when will it be available for trading, and when it does get listed, will the price be on a similar side on 261 and thereabouts, or can we see a fluctuation right there?
Once it gets listed, in my view, it will take at least 2 to 3 months to get this listed, because now they need to apply for SEBI permission, etc., which will take time. So minimum 2 months and maximum 3 months is the time horizon in which this share will get listed. But as I was telling, as far as the Reliance industry is concerned, they are going to come out with extraordinary set of numbers in this quarter, because their refining margins were quite robust this year. And if I compare last year, combinedly, oil marketing companies have incurred a loss of 16,000 crore.
Yeah.
And this year I'm expecting they'll do 40,000 crore profit. And the major chunk will go to Reliance Industries. So I'm expecting this quarter they may even surprise us in upward of 22,000 crore earning in Reliance Industries. So as far as Reliance Industries is concerned, there's always a buy on any decline. We should add in the portfolio. But as far as Jio Financial Services is concerned, I think once we get listing opportunity or exit opportunity, we should exit once.
What does the entry of Jio Financial Services really mean in the entire realm of the NBFC space that we have currently?
Reliance Jio will be primarily focusing on the digital platform, and on account of the wider reach by their various Jio Store and Jio Mart app, etc., they will try to explore this market, and they will give surely competition to Bajaj, Twins, and HDFC, L&T, Aditya Birla kind of players who are quite aggressive in this field. But still, in my view, 1 lakh crore kind of market cap, where you don't have those proven credential or those kind of numbers, will be a challenging market cap to maintain.
The bull run, meanwhile, continued on D Street, with markets extending gains as value unlocking on index heavyweights, including Reliance and ITC, supported buying sentiment. Amid constant FI inflows, Nifty was barely shy of 20,000 today. Sensex was up 474 points and the Nifty 146 points, ending at 19,979. Top gainers today: ITC, Kotak Mahindra Bank, ICICI Bank, Dr. Reddy's and Grasim. Top laggards: Infosys, Ultratech Cement, Bajaj Finserv, Eicher Motors and Britannia. Tech major Infosys shocked the street by nearly halving its revenue guidance for the current year. In its results declared for the April to June quarter, Infosys sharply trimmed its revenue guidance for FY24 to 1 to 3.5%. That's from 4 to 7% earlier. It said the revision was on account of challenging demand environment. The company's consolidated net profit declined 3% sequentially to 59.45 billion rupees in April to June, missing the average estimate of a 0.8% rise. India's second largest IT services company reported a consolidated revenue of 379.3 billion rupees for April to June. That's up 1.3% from a quarter ago period, beating analysts' average estimate. The company's operating margin came in at 20.8%, down 20 basis points sequentially, and the net headcount fell sharply by 6,940 employees. That's during the quarter. Infosys completes the results season for big tech in India, a season which has been rather underwhelming. My colleague Sakshi Batra joins me to break down some of the key concerns the IT sector is facing. Sakshi?
Largest IT company Infosys has now declared its Q1 FY24 earnings, where the profits have dipped by 3% sequentially. But the bigger disappointment has actually come in the form of its revenue growth guidance. The company has sharply revised its growth guidance downwards from 4.7% earlier to 1 to 3.5% this year, and that's on the back of uncertain global environment. And this comes right after TCS, HCL Tech and Wipro have already posted muted set of earnings for Q1. And one can clearly see that the big four IT companies in India have something to worry about. Remember, the global slowdown concerns in the US and Europe, which are the major revenue drivers for India's outsourcing companies, have led to significant slowdown in these companies' businesses. Experts believe that guidance revision by Infosys could also be on the back of project cancellations, and also Infosys has reported second straight quarter of employee headcount decline. In Q1, its headcount has shrunk significantly by almost 7,000. Both TCS and HCL Tech also had missed the street estimates when it comes to their earnings, with low hirings also during the quarter. Remember, TCS hiring fell by over 90% on a year-on-year basis. TCS hired just about 500 employees in Q1 of FY24. Wipro, on the other hand, had seen an 8,000 dip in the net headcount additions in Q1. Also, HCL Technologies and Wipro together saw headcount plummet by about 11,000. So clearly, on the one side, slower hiring, the guidance cut down and the revision downwards right there. Also, we have been seeing lower spends by the client. All of these as major concerns for the IT companies, reflecting the kind of slowdown that is being felt in the Western countries, in the US and Europe.
It's not just Infosys results which are shocking. The hiring trends also portend some disturbing trends in the tech industry. Net employee addition has dropped a combined 135% at TCS, Wipro and HCL Tech. This means where the companies had added 31,000 employees this quarter last year, this year they've seen a fall of nearly 11,000 employees. This is in line with the muted financial numbers shared by these companies. Akanksha Chaturvedi gets us a deep dive into this trend. A closer look. Akanksha?
That is right, Abha. Hiring across major Indian IT companies has dampened in Q1 FY24 as compared to the year-ago quarter. If we take a close look at the numbers, we see that TCS only added around 500 people to the company in Q1 FY24, while this number was over 28 times bigger last year. TCS added over 14,000 employees in Q1 FY23. At Wipro, this trend seems to have worsened. In Q1 FY24, Wipro's headcount actually reduced by around 8,000 employees, while in Q1 FY23, they had added over 15,000 people to the organization. HCL Tech was also in line with this trend. The company's headcount went down by over 2,500 people in Q1 FY24, whereas they had added around 2,100 people in the year-ago quarter. This slowdown is in line with the broader slowdown in the industry, which is caused by the cutbacks in IT and discretionary spending across the world. Back to you, Abha.
In a massive blow to OTT fans in India, Netflix has restricted password sharing in the country. Emails have been sent to users saying that the Netflix accounts are meant to be used exclusively within a single household. The restrictions were earlier placed in more than 100 countries to stop revenue leakage due to password sharing. We're joined by Danny DeCruz to answer some of the questions users have about this move. Danny, why has Netflix decided to stop password sharing in India?
So this all started in early 2022 when Netflix witnessed a drop in subscriber base for the first time in a decade. Seeing no other way to increase its consumer base, the streaming platform decided to put password sharing restrictions in place. Initially, password sharing restrictions were limited to the United States and a few other regions. So far, India was spared, but not any longer. Netflix announced that it won't let users in India share passwords anymore.
What does this mean for its subscribers, especially those who pay a premium for all the multiple profiles, Danny?
So, Netflix has announced that you can only share your account with people who live together in a single household. They say it's also fine to use the same Netflix account when you're traveling, even when you stay at hotels. But if you share your Netflix password with a person who does not live in your home, it's a definite no-no.
And how will Netflix detect subscribers sharing passwords?
Now, Netflix says it can use a combination of IP addresses, device IDs, and account activity from the devices signed into the Netflix account to detect if an account is being used in or out of the primary account holder's house. That's not it. Netflix may also ask you to verify a device by entering a verification code sent to the account holder.
All right, Danny, thanks so much for joining us with that. British Prime Minister Rishi Sunak has hailed the fresh £4 billion investment by the Tata Group in the UK. He was joined by Tata Chairman N. Chandra at a Jaguar plant near Gaydon in England. He described the Tata Group's decision to build an electric vehicle battery plant in Britain as a fantastic vote of confidence in the UK's economy. According to reports, the British government has provided subsidies worth hundreds of millions of pounds to lure the investment, which was earlier being routed to Spain. The new plant will supply JLR factories and create up to 4,000 jobs while producing an initial output of 40 gigawatt hours.
Look, first of all, this is a fantastic vote of confidence in the UK and the UK economy. It's one of the largest ever investments in the UK auto sector that we've seen. It's getting us ready for the future and the transition to electric vehicles. It's billions of pounds of investment and thousands of jobs, so it's great news. Now look, there are a range of things that go into a company making a decision like this, and one of them is actually really important. It's the quality of our skills, the quality of our people here who are fantastic. You just walk around this plant and you see what incredible people we've got. It's about the competitiveness of our tax regime. It's how we approach regulation, and it's about the relationship with the government, making sure that we can support companies like Tata and JLR to make these investments. Those are all the ingredients that go into it and many more, but the main takeaway today is a fantastic vote of confidence in the future of the UK economy.
Foxconn is ramping up its investments in India days after it pulled out of a marquee semiconductor deal with Vedanta. Top officials from the company have been on a whirlwind tour, meeting chief ministers of Karnataka and Tamil Nadu in a span of just 2 days. While the company had already announced an 8,000 crore rupee investment in Karnataka earlier, it's reportedly willing to further open up its purse.
It's been 17 years since the world's largest contract manufacturer first stepped into India. During that period, the Taiwanese company, best known as the largest contract manufacturer for Apple and assembler of the iconic iPhone, has constantly raised its stakes in India, slowly revealing ambitious plans for the country. Even the collapse of the ambitious $19.5 billion deal with Vedanta for manufacturing of semiconductors in the country has not fazed Foxconn. In a fresh investment drive, top officials from the Taiwanese company met chief ministers of Karnataka and Tamil Nadu earlier this week. While Karnataka announced an 8,800 crore rupee deal, Tamil Nadu did not reveal an investment proposals. There is, however, talk of Foxconn setting up a new facility for high-end electronic components. The recent few months have seen a slew of investment proposals from the company. These include a $500 million proposal to manufacture wearables like Apple AirPods and generate 25,000 jobs. Next came a plan to invest 8,000 crore in Karnataka to set up a mobile manufacturing plant near Bengaluru. In June, the company also announced that it plans to build electric two-wheelers in the country. On Monday, a second investment proposal of 8,800 crore rupees was announced for Karnataka, where the company will manufacture screens and other parts for mobile handsets. In the middle of these plans, the manufacturing giant also announced plans to go ahead with its ambitious semiconductor plans, indicating that it was in talks with other giants like TSMC for a joint venture. Currently, Foxconn has manufacturing presence in Sri City in Andhra Pradesh as well as in Sri Perumbudur and Sunguvarchatram in Tamil Nadu. It also has R&D facility in Chennai and Bengaluru. Recently, there have been reports of the company ramping up its presence with new plants in Devanahalli in Karnataka and on the outskirts of Hyderabad. Meanwhile, there are reports that Foxconn is slowly losing its initial hesitancy it had towards its India plans, given the success the export of Apple iPhones has seen in the past 1 year. The company is in fact viewing India as a serious contender to de-risk its China operations. Bureau Report, Business Today Television.
And here's what else is making news in the corporate world. According to a report, US-based solar manufacturing company First Solar is set to invest billions of dollars for solar panel production in India. The materials for the production will not be sourced from China. U.S. Energy Secretary Jennifer Granholm also mentioned that the U.S. will have to add 2,000 gigawatts of clean energy to its electric grid by 2035 in order to meet the goal of using 100% electricity from clean sources. Aviation watchdog DGCA in its audit report on Go First airline has noted the carrier needs to either scale down its resumption plan or hire more hands to restart operations. The cash-strapped airline owned by the Wadia Group has reportedly decided to scale down its resumption plans by around 30%. DGCA has raised 13 observations in its audit report, highlighting that the airline is facing issues such as lack of trained pilots and cases related to funding, refunds and spare parts. Apple reportedly developing its own artificial intelligence language models internally as competition in the AI landscape gets fierce. Apple has constructed its own internal infrastructure upon which it will build large language models to compete with OpenAI's ChatGPT, Google's Bard and Meta's Llama. The new framework is codenamed IAX. That's where we leave it on the show tonight. Thanks for watching.